Hi there, ladies and gentlemen. It's James Marley here, co-founder of Livewire Markets, and welcome to The Pitch. And today, you're going to be learning about one of the oldest listed investment companies on the ASX. I'm joined today by Angus Gluskie, Managing Director at Whitefield. Angus, great to have you in here at Livewire. Thanks for coming along.
Thank you.
All right, let's kick it off. As I mentioned, one of the oldest listed companies on the ASX. Can you tell us a bit about the background of Whitefield?
Sure. The company was incepted in 1923, in the heyday of the booming 1920s, and it listed shortly thereafter. So it's been around for a long while.
And in terms of the investment strategy underlying the LIC, can you just give people a bit of a flavour for what it's trying to achieve?
I guess like many Australian share investment strategies, we're looking to generate dividend income and earnings out of the stocks that we hold. We're aiming to hold a diversified portfolio to give people a good level of risk control. And through those two things, deliver a good rate of return over a long period of time, which we hope we've done.
Okay, so a combination of both capital and income?
Correct, yeah.
Okay. In terms of where we find ourselves today, in terms of the investing market, what would be your observations around what investors see and how you're reading it?
Well, it's interesting times at the moment. There certainly are some parallels with some of the things we've seen in history. I think one of the interesting elements that's there at the moment is that we're in a period of unprecedented technological change. High-speed communications, high-speed data storage is accelerating the pace of learning, development, and change. And traditionally, that's meant that economic growth has tended to accelerate when you get those kind of technological changes, and that in turn throws up investment opportunities.
It's interesting at the moment. It seems like we have those ingredients of change, but economic growth is slowing. Does that mean brighter times ahead?
Well, I think technological change and the opportunities it throws up is something that occurs over a sequence of decades. It won't necessarily occur instantaneously. And certainly, at the moment, we're also facing, the challenges that inflation brings. And again, that's the thing that's limiting economic growth at the moment. Nominal growth is strong, but growth adjusted for inflation is a bit slower.
Okay, change, growth. You talked about where we find ourselves today. Is there a prior cycle or past time in history that you think is analogous with where we find ourselves today?
Yeah, well, the most recent period of inflation that's been there was the 1970s, 80s experience. And look, the inflation at that time was initiated by something different. It was the oil price shock back in those days. However, there are other parallels to today. I think any time that you get a factor driving up the costs of living for consumers are then forced to seek higher wages to compensate. And as those higher wages go up, the employers have to then charge higher prices for goods and services. So there's a very natural spiral or tendency to spiral that occurs when you get that inflationary impetus. And if you think about it today, the impetus wasn't oil prices, but it's house prices. It's everyone's biggest expense.
Yep. And so if we bring this to the investing context, obviously each cycle is different. What do you think it's going to take to be successful as we look forward from this point in time over the next 5-10 years? What do you think investors need to get right?
Well, look, investing's always about just trying to balance up the price you're paying for an investment with the investment's ability to generate earnings. So you do need to be alert in these periods of technological change as to where the economic growth is going to come from and how different businesses are reacting to that. So I think it's important not to rely purely on the past, but to have an eye to how those influences are shaping the future of different businesses. So I think alertness is a really good quality for investors.
You've talked about valuation. Sounds like price you pay matters a lot at Whitefield. Could I get you to talk specifically to some of the sectors and a few examples of where you are seeing opportunity?
At the moment, I guess we're seeing opportunities come out from areas of technological change. There's a company called Ventia Services who's an interesting stock because it's providing services into developing areas of infrastructure. So that's a company that's likely to benefit from the process of change. At the same time, we're always looking for companies that have got strong positions in the industries in which they operate. So we're looking at quality metrics and companies that rate well on those. So, and in that sense, you can find some companies that have been around for a long time. Brambles, for example, continues to retain a good market position, both here in Australia and overseas, with a product or a service that's essentially very fundamental, pallets.
Yep. Yeah. Anything else that you wanted to call out?
Well, maybe thinking across the financial services space, a stock like Netwealth is positioned again, strong positioning in the financial markets climate that's developing at the moment.
Yeah, absolutely. Flip it around. What are you cautious on? Where are you seeing risks?
Okay, risks, and as investors, it's worth thinking that the risk can come or arise for a number of reasons. Sometimes it's merely because of price. Price and expectations have been driven up too much. Maybe an example there at the moment is Commonwealth Bank. It's still a good fundamental business, but it's been moved to very expensive levels, which makes it hard for an investor to get the kind of return that they're after if they're buying at that level. Conversely, or on the other side, risk can arise just because maybe the market's not appreciating some of the risks that maybe lurk inside businesses. Good example on that front would be NextDC. It's a business that's building data centres, which is quite an exciting growth prospect.
Very popular, yep.
Yeah, but it's meant investors have become very excited about the stock. The stock's been chased up. Yet beneath the surface there, it's worth thinking it's a business that's spending a lot on CapEx. CapEx is inflating. It would be easy for the capital expenditure profile to maybe be more than people currently expect. The redundancy in equipment CapEx could be faster than people expect, requiring the business to have to pay more. And equally, it's a business that would be exposed to potential security issues. If there was a breach of security or hacking into data centres, that could certainly be a problem. So there you go. You've got an expensive stock. It's carrying some risks that maybe aren't priced in. You need to be cautious.
Okay, very good. Well, ladies and gentlemen, I hope you enjoyed our first episode of The Pitch with Angus Gluskie from Whitefield. Make sure you tune in because we've got more episodes where we're going to explore some of the other opportunities Angus is seeing.